Hey, good afternoon, everybody. Welcome to our webinar. We're going to give everyone just a few minutes to jump in from the waiting room, and then we'll get started momentarily. Thanks. All right, let's go ahead and get started. Well, good afternoon, everyone. My name is Aaron Mahl, Executive Vice President here at iTValuations, joined by my colleague and friend, my esteemed colleague, Greg Northrop, Managing Partner of IT Tax Advisors. And our webinar today explores transactions and taxes, understanding the impact of buying and selling MSPs and IT firms. Thanks for joining us. I want to thank this group especially for joining us. This webinar was supposed to take place last week, but Greg became ill. Sometimes it happens after tax season, I guess, and so we were unable to have the webinar last week, but he's back and better than ever this week. So we're excited about that. So thanks for being flexible and joining us on the webinar. A couple of housekeeping items. This will be recorded, and so don't need to take notes. This will be sent to you shortly after the webinar, so you can review it every night before bed if that's what you desire. So as those of you who have attended our webinars before know that one of the traditions we have is we have a trivia question to start every webinar, and we give away an Amazon gift card to the individual who correctly answers the trivia question correctly in the chat first. And this trivia question actually is a throwback. So some of you are groupies and you attend every one that Greg speaks at. You follow Greg from session to session, and I understand why. Others of you, this might be the first time. So I'm going to say this on the front end. You have an advantage if you've been a part of this from the beginning. So a year ago this week, actually, we started hosting bi-monthly webinars. And before we did that, oops, let me go back. Before we did that, I was actually in a before we scheduled it, I did not realize I was going to be on vacation during that time. And I was on vacation. And I hosted the first ITV webinar ever from a hotel room in what town? If you know the town, and you can probably go back on our website and find the webinar from 2024. But if you could be the first person to name the town in which I was residing for that week, we will give you that $25 Amazon gift card. Drop that in the chat if you get a chance. Okay. And by the way, just to be clear, it's city, just to be clear. Upcoming webinars, a couple things along the horizon. In just 2 days, actually, we'll be having a webinar with Ted White from Vertical Talent Solutions. What role does employee retention and employee satisfaction play in the valuation of your company? Does it play a role in the valuation of your company? How do those two factors influence, or do they influence, a potential buyer of your IT company? Or if you're a buyer, should those things matter to you as you're looking at a company to possibly sell? We're going to tackle those questions and so many others with Ted White from Vertical Talent Solutions, 2 days. So go ahead and check out the link on the slide, and we'll get you registered for that. We get often asked the question, hey, how's it looking from an M&A perspective? In fact, just today, had coffee with a local IT owner here in Ohio, and he just said, hey, give me the landscape. What's happening? What's the velocity like? What are you seeing multiples wise? So we're going to talk through what our learnings have been through the first half of 2025. Reed Warren, our CEO, and Corey Kearns, our VP of Transactions, will be on that on July 15th. And then we're going to highlight one of our transaction stories. Net Effect, an IT company based out in Las Vegas, Nevada, transacted about a year ago. And at iTValuations, we always define success by what the buyer and seller say 12 months removed from the transaction. We think that's important to get through the honeymoon stage, but also to see how things are going since. So we've asked them to kind of go back through their story, talk about what they learned through the process, what they would do differently, and would love to have you join us as we talk to David and Shelley Rounds of Net Effect on July 29th. So save the date for those things. All right, let's dive into transactions and taxes. The impact. Greg, do you want to introduce yourself a little bit and talk maybe briefly about IT tax advisors and kind of the role that organization plays within the ITV family?
Yeah, absolutely. Greg Northrop, been a frequent flyer on the webinar series since crazy. It was a year ago that we started this. But yeah, my background, I think I was bred to be a CPA. My dad's a CPA. There's a picture of me 2 years old holding a quick finder, looking at all the different tax laws. So, I mean, I knew what depreciation was at the age of 6. So, I mean, I think I was kind of like bred for this career, and neither here nor there. I spent nearly a decade at BDO, large international firm, fifth largest in the world, and really worked with high net worth individuals, their family-owned businesses, and then private equity groups specifically, and did a lot of transaction work around how to be proactive before a transaction, how to be proactive for the family to protect their wealth and whatnot. And what I started to realize as I came to ITV in the September of 2023 is there's a lot of misconceptions around taxes in transactions. I think there's just a lot of unknown. Everyone knows that Uncle Sam is going to get a giant payout upon a transaction, but they don't really know like what the payout is, and they don't even know like, yeah, my tax guy, he files my tax return, or she files my tax return, and they're great, but they just file the tax return. And so they're not getting the consulting or the like tax strategy type of advice. And so that was what led into us launching IT Tax Advisors. It was almost a year ago now that we officially launched it to the IT service space, of just saying, hey, we want to actually be a firm that is going to be proactive in our communication around tax law changes. We want to be proactive in talking to you about your business, and is this the right structure for you and what you want to achieve in your goals and exit planning. And then also thinking about when you do transact, how can we help navigate some of those tax intricacies and complexities that come up when you go to sell your business. So that was really where we've spent our time. We've grown a lot in our first year in terms of adding a bunch of new clients in the IT service space. And over, I would say 60-70% of the historical tax returns we looked at, we found opportunities for additional refunds or additional things that could be done, in a more efficient manner to kind of create additional cash flow for the business as they are, continuing to grow and scale in advance of that transaction date. So that's a lot of what we do. But this topic today, we really want to focus on the transaction piece of it, because I think there's a lot of unknowns, a lot of complexity. No one's going to leave this meeting to being an expert by any means, but I think it's going to be helpful that now you've at least heard these terms before, so that you can plan proactively ahead of a transaction.
Yeah, it might be that you leave with some questions to ask your CPA, and just make sure that
Exactly.
whatever your plans are, that's being communicated effectively. Well, Greg, I think one of the things that when we talk through this topic, and maybe the opportunity to talk about these issues within the topic, the reality is that most IT owners are going to transact one time in their life, and so they're not necessarily experts. They're not attuned to all the legal and the tax elements of the deal. And I think when we start at 30,000 feet, there's a lot of ways we could take this conversation. We felt like the most common thing to see in a transition from a seller in a transaction is really from the seller's LLC into an S corp.
Yeah.
Now this is the alphabet soup of tax designations and all those things. But maybe walk us through that process and why it's important to both the buyer and the seller.
Yeah, so what we're talking about here is an F reorg, going from your current S corporation into an LLC or disregarded entity. And the reason why we're talking about this is, if you're an S corp on the call today, which I will say I'm roughly 90% of the companies we work with are S corporations. And why are they an S corporation? Because when they started their business 25 years ago, that's what the CPA told them to be. And that might have been the right structure for you for the last 25 years. There's nothing wrong with an S corp. There's a lot of benefits to it. But if you're someone that's looking at buying, if you're someone that's looking to sell, you're gonna, in any sales transaction, we always have an F reorg, because it's basically required in order to facilitate the transaction. And then if you're looking to buy someone, if you want to offer rollover equity and kind of compete with some of the larger PE-backed groups out there that are offering rollover equity as part of their acquisition strategy, you almost have to go through an F reorg to have that option be on the table, because you don't want to offer up equity within your S corp. So what an F reorg is you're effectively, if you go to the next slide, Aaron, you're effectively creating a brand new holding company that sits above your current operating S corp. And so what ends up happening is that new holding company ends up being your tax filing entity. That's where you file your taxes from. That's where you are technically holding the units of the previously existing, legal entity of your, MSP Operations Inc. in this case. MSP Operations Inc. actually goes through a reorganization at the state level to become MSP Operations LLC. Now, you might already be an LLC that's taxed as an S corporation. Then no reorg is actually required in terms of an incorporated to an LLC. You just have to go through this process and follow the legal tax steps of creating the new S corp, dropping the shares into it via, an agreement drafted by an attorney, and then file the Q stub election, which is a wholly owned subsidiary of an S corp election for your MSP Operations LLC business. And then now from that place, this is where every transaction starts. Because now when a buyer comes in and wants to buy your company, they're going to want to buy the shares or the units of your company in a stock deal, because then all the employee agreements transfer, all the contracts for your customers transfer, all of your agreements with your vendors transfer. So it's a much simpler legal transaction when you do it on a stock basis or a unit basis. But what happens from a tax standpoint is when you sell in this structure, you have the ability to make an election under Section 338H10, where both buyer and seller treat the deal as if it was an asset purchase, even though legally it's a stock purchase. So you kind of get almost the best of both worlds from a buyer standpoint, is you get that seamless handing over of all the existing agreements legally, as well as you get that asset-based treatment. So you get an intangible asset that you can amortize over 15 years. Now, some people are thinking to themselves, well, from a seller's perspective, it's not beneficial for me to sell in an asset deal, right? Well, the nice part about this industry is generally in IT services, you're not asset intensive businesses. You don't have a lot of depreciable assets or fixed assets. So really, when you do the laying out of the different asset classes that are being sold in a deal, almost 95%, if not more, of what's actually being purchased is goodwill or an intangible asset, aka your customer list and your people and your agreements. And so the taxes ends up being the exact same to you as the seller. And doing this structure is a way to kind of seamlessly do a stock deal while taxing it as an asset deal.
So it sounds to me like the F reorg is inevitable. It's
Is
going to
inevitable.
happen. Right. So let's talk about maybe someone on the calls like, I'm 5, 10 years away from selling, or maybe I'm a couple years out from maybe buying another smaller MSP.
Yeah.
Any advantage or benefit to going through an F reorg right now?
Yeah, so this is where I talked about, like, from a buying standpoint, if you're looking to potentially offer rollover equity as part of an acquisition strategy, or maybe you have key members of your management team that you want to try and offer equity to as either a strategy of potentially allowing them to take over the company one day, or even just as an incentive, kind of equity-based compensation plan. In an S corp, you're really restricted on what you can do from an equity standpoint, because you can't have a second class of stock. You can go down the phantom stock route, but that's really just a deferred bonus or retention bonus program. So if you really want to try and give equity to someone, you really should change your structure, because any equity you give out in an S corp, you're giving out pro rata of everything you've already built. Versus if I give out equity in an LLC and now it's taxed as a partnership in the tax code, I can actually designate how much of the equity value do I want to be carved out to that owner. That amount could be zero today. I could give someone a profits interest where essentially your units are worth nothing until we sell. And then when we sell at a sales price over X on a liquidating distribution, now you get 5% of that amount. So now I can kind of hold people to certain objectives, give them equity so it makes them feel like a true owner. It's worth nothing. So if they leave the company, you don't have to buy them out. It's still worth nothing. So that's a unique kind of creative planning tool with that. The other piece is, again, I mentioned rollover equity. Now, if you do rollover equity and buy a company with your LLC, you create a partnership and you can give LLC units in exchange for the units that you're buying in, basically buying through their F reorg that they're going to have to do. And that's where now you can give them 5%, 10% of the company, whatever the percentage ends up being, in order to facilitate the deal and get another partner to run with you in your pursuit of reaching your, value objective.
Yeah, so on that first comment around, let's say you're offering an employee some equity, say your current valuation is 5 million, you offer equity at that stage, then the basically the equity is on the growth from 5 million on.
Correct, exactly. They wouldn't get a percentage on any that first 5 million because they maybe weren't a part of it, or you don't want them to have a part of it because you were the one who was the 100% owner from 0 to 5. So you can retain all five. Versus if I give equity in my S corp and it's 5%, well, I just gave them 5% of $5 million. So I gave them $250,000 of value immediately. So that is that benefit, and that's where, again, when you do rollover equity, a lot of times you want to give them a dollar for dollar value on the shares that they're bringing to the table, or the units they're bringing to the table, That's really hard to carve out and do in an S corp scenario versus if you do it at a, on an LLC partnership level. Now I can rework the cap table in a way that if I'm giving you $1 million of rollover equity, you're only getting $1 million of units in exchange as part of the transaction.
So Greg, let's say someone on the call wants to do that today. They say that sounds like a plan. What are the steps? How complicated is it? Walk us through that.
F-reorgs are fairly straightforward. You just have to work with a tax attorney that has done F-reorgs before. And really, most attorneys I've talked to, it's no more than a 30, 45 day at most process. It's pretty quick. It really depends on if you're already in an incorporated state or an LLC state. If you're already in an LLC state, it's actually a lot quicker because you're already an LLC legally. You're not incorporated, so you're not undoing the incorporated to become an LLC. You can just essentially change your tax designation and just file the proper tax forms, as well as the proper legal forms to show the contribution of units into the newly created S corp in exchange for S corp shares. So it's a pretty straightforward process, and it's one that is not super expensive either for the most part. I mean, I've seen some firms where it's maybe like 5 grand, 10 grand, potentially more depending on who you work with, but it's a relatively like inexpensive process to basically just get this structure in place. And now someone might ask, Greg, but why, if I don't have aspirations of giving rollover equity, and I know I'm going to have to do this at a transaction anyway, it's like, why do it now? Like, should I pull that forward? Not necessarily. You don't have to, but I would say that this gives you a lot of flexibility that if you already do it now, it's not changing anything for you from a tax standpoint. The only thing it's changing is who is the legal entity that you're filing a tax return for, but otherwise everything else operates the exact same. So there's really no harm in doing it if you want to just do it and give yourself that flexibility of now you could sell without having to do the F-reorg upon a sale, or you could go and do some rollover equity or different equity options with your employees.
That's great. Thanks, Greg. For those of you maybe jumped on late, you see a couple of cities in the chat. The trivia question for today, which wins you a $25 gift card, is what city was Aaron in a year ago this week, actually, when we hosted our first iTValuations live webinar. There is not a correct guess yet, and so it's worth a guess. If we don't get any better guesses, I might give a clue in a few minutes, so stay tuned for that. Let's stay on the topic of restructuring, and it is a U.S. state, Sam, just so you know. I'll narrow it to the United States, 48 states. I'll narrow it to that, and I'll even say east of the Mississippi. How about that? So Greg, when thinking about restructuring, are there some steps that owners can take to minimize tax liability?
100%. So one that's commonly considered that's out there that a lot of people have talked about, maybe you've already heard about it, is Section 1202, which is the Qualified Small Business Stock Gain Exemption Program. So effectively, that program is only available to C corporations, and it's only on newly issued C corp shares. When the shares at the time of issuance, the company has less than $50 million of assets, and you have to hold the shares for 5 years in order to get the full gain exemption. Now, what is the gain exemption? The gain exemption is the greater of $10 million or 10x your basis. What is your basis? Well, if you convert in like what this picture is kind of hypothetically suggesting, converting your current S corp into a C corp to facilitate this, your basis is the fair market value of your company on the date of conversion. So that's where you could potentially have, if your company is a $3 million company today and you wanted to go through this process, you could potentially exclude up to $30 million of gain on that first $33 million of gain because you pay tax on the first three, and then the next 30 would be tax free on the appreciation for that Section 1202. So how you get to that, you can't just take your existing S corporation and break your S election and become a C corp. Doesn't work for Section 1202. 1202 only works if you create a brand new legal entity over here and you go through that F-reorg process we already talked about, and now you do an exchange of C corp shares for LLC units between the holding company and the C corp. And you see that exchange arrow that's listed on the slide there. So effectively under Section 351, I can take, shares or units from one company and shares or units from another company, and I can do essentially a like-kind exchange. It's tax-free, and I can essentially deem that the value is equal in that exchange, thereby, qualifying as a tax-free reorg for purposes of accommodating to the 1202 requirements. The other benefit of doing that is then now when you go to, well, I guess it's not a benefit, it's more of a detriment, and this is why people don't always love the 1202, is you have to sell in a stock deal. So if you're thinking about, yeah, I want that flexibility to sell as either asset or stock deal, or, we talked about the Section 338H10 election, selling as a stock deal that on paper, but it's actually taxed as an asset deal. A buyer wouldn't have that flexibility in this scenario. A buyer would have to buy the shares, and they're not going to get an appreciable asset in return, which ends up being a really bad answer for the buyer. And so there are some buyers out there, that I've talked to, people that are a part of Evolve and people that are, we're close to, that would say we wouldn't touch a C Corp with a 10-foot pole. And that's fine because it doesn't fit their strategy. So again, there are some issues to be like navigated with it. But here's the fact pattern I'll tell you. If you check these boxes, this is where this opportunity might make sense for you. Checkbox number one is you don't need the distributions from your company to live off of. You are perfectly fine living off your W-2 wages, and the only time you take distributions is to pay your taxes. Number two, you have really high growth aspirations. Like you're saying, like, I'm 3 million today, but I'm going to be 20 million in 5 years. Great. And then number three, you have at least a 5-year timeline or trajectory to exit. If you tell me you have a 5-year timeline, by general rule, everyone who tells me whatever their timeline is, they're willing to sell 2 years earlier. So if you tell me you have a 5-year timeline, that's not long enough. You need at least a 7 to 10-year timeline to pull this thing off, because by year 5, you're going to be exhausted and you're going to want to sell. And so if you only have a 5-year timeline, you're going to feel like you're holding on and potentially losing value as the company's coming backwards and not actually fully maximizing the return you can get from this. So this is not a strategy for everyone, but if you fit that criteria, this is the best way to mitigate your tax liability. Because again, if you go out there and hit that, 5-6x growth through acquisitions or whatever your strategy is to get to that point, well, then you just created tax-free wealth for yourself and your family that in a way that there's no other way in the code to do so.
That's great. I hope your CPA is talking to you like this. This is the kind of advice Greg and his colleagues give from IT tax advisors. Still not seeing the correct city of where I was a year ago. Another clue, Northeast. So I'm going to kind of zoom in on Northeast a little bit. While you continue thinking about that as an engaged audience, let me ask Greg another question. Greg, just at a high level, structure aside, what is the general tax liability an owner can assume to pay on the sale of their business?
Yeah, generally, we mentioned this before with the F reorg, whether it's an asset deal or a stock deal, the number one thing you're selling is an intangible asset. So again, regardless of how the deal is structured, almost all the deal is going to be capital gains to you. And for capital gains, you have the capital gains rates, which it's an escalating bracket of 0, 15, and 20. Now, presumably in the year you sell your company, you're probably already in the 20% bracket because you're probably already potentially even over that threshold with the income from the business before you even add, the capital gain income on top of that. So if you're at 20% federal, there's also a 3.8% net investment income tax. Now, that tax does not apply if you are an owner of a partnership or an S Corp and you're active in the business. If you are not active in the business or you own a C Corp, that 3.8% tax applies to you. So therefore, your rate could jump up to 23.8% for federal. Then you look at the state and whatever state you're living in. So again, state tax is a little bit complex and I don't want to go through all the nuances, but at a high level, if you are a resident in a state that has state income tax, you can reasonably assume 100% of your gain is going to be taxed by that state. If you live in a state that does not have income state, you're one of the fortunate few that live in Florida, Texas, Nevada, Wyoming, Washington, I think South Dakota, I think that's most of them I just listed off there. If you live in any of those zero income tax states, well, you might only pay a portion of the gain from at the state level from a tax standpoint, because there's an apportionment that happens within the business, that you apportion that gain based on where your revenue is, where your people are, where your property is. And so, yes, Doug, great point. They do have a capital gains tax now. So it's not, it's only on the business income that is exempt. So that's where laws are changing all the time too. So it's always important from a state tax standpoint to really understand what is my state tax exposure. And for those of you that live in a really high tax state like California, New York, right here in Minnesota where I am, and you're like, man, I got to get out of the state before they like, suck me dry. If you just go get up and move, that doesn't necessarily change the state tax impact of you selling your business. A lot of states, like Minnesota, for an example, has a residency rule that says if you established your business in the state of Minnesota and you were a Minnesota resident when you built the majority of the wealth in the business or value in the business, even if you leave the state and you go live in, say, Arizona or Texas for 3 years, Minnesota is going to claim it's 100% Minnesota business income, and you have to pay 100% of that sale of the business to Minnesota. And so you got to be careful with just getting up and moving and assuming that changes your state tax footprint. The only way you can truly sever your state tax ties from your business is going through kind of a restructure that is depicted here, where you're actually kind of now setting a brand new company like this new C Corp. And now it's a brand new reporting entity. It's a brand new legal structure. And even better yet, instead of just doing a transfer that's a tax-free exchange, you actually do a sale. You do it via a note with a stated interest rate. You don't actually pay any principal, you just pay interest on it until you sell your C Corp shares in the future. But doing an actual simulated sale with a note, now you can prove to the state of California, New York, like, hey, I sold that S Corp. We're no longer that iteration of the business. We have now taken a new iteration as a Wyoming corporation, and now we're no longer, in that state. And so that's really the only way to reset your state tax footprint.
So, Greg, what I'm hearing you say is if you're going to move from Minnesota, move because of the snow, not because you're going to save a bunch of taxes, right? Like move
Yeah.
because of the weather, right? Yeah, it makes sense. I've not seen the correct answer yet. Clay is not an MLB town, but you're on the right path. That's all I'll say. Greg, for sellers, any tips that you can give a seller today, and they might not be selling today, but maybe in the next year, 2, 3, 4, 5 years, that makes their transaction more simple, or they can get a better tax answer because of something they do right now.
Yeah, so one very easy low-hanging fruit is majority of companies I look at when I look at their tax returns are filing on a cash basis. Nothing wrong with filing on a cash basis. However, when you go to sell, if you're still on a cash basis, the deal is going to be done based on accrual basis financial statements. And so what can happen is all of a sudden when you get to the deal table on an accrual basis, you have deferred revenue that is not in your P&L because you haven't actually earned the revenue yet. And therefore, that deferred revenue has to go to the buyer because they're going to be the ones performing the revenue. And all of the cash associated with that deferred revenue has to go to the buyer. However, you, on a cash basis, are paying tax on that cash as if you earned it. And therefore, now all of a sudden, it's kind of a bad tax answer where now all of a sudden I'm paying tax on cash I earned that I didn't actually get the benefit of. And so it's it might not be a material number for you and your business depending on how you're doing your cash flow and your invoicing and the size of your deferred revenue. But for some companies, if that's a big number, that could be a material impact to them from a tax standpoint that you're now suddenly paying taxes on cash that you don't actually have in your business. And it would be a very simple change to just flip to the accrual basis method. So it's something that you and your CPA could be doing all along that, say, maybe you're on a 5-year trajectory to sell. Each year, we just take a look at your balance sheet and say, hey, is this a good time to convert? Because I'm of the opinion I don't want to convert and do a method change if it's going to be a net negative effect to your business, meaning an increase in your tax liability. Although technically you can amortize that over 4 years, I just don't like doing a method change if it's going to be a net deficit. It doesn't make sense. So let's look for the tax year where there's a net benefit to flip from cash to accrual, and let's realize that benefit so then you can get a tax deduction, get some tax savings from making that conversion. And now you're in kind of the more optimal state from an accounting method standpoint for taxes to marry up with the transaction.
That's good, Greg. I think obviously in a transaction, we've been talking a lot about the seller. the buyer's not necessarily paying taxes in a transaction, so there's not necessarily anything there, but a buyer is buying someone who may or may not have paid their taxes in any way they should have. And so maybe any advice as a buyer maybe vets a potential seller during due diligence around issues of tax.
Yeah, buyers be weary when it comes to specifically sales and use tax and then state and local tax. We haven't seen a whole lot of issues from a federal tax standpoint because again, most of the companies where we've represented and helped sell are S corporations. So from a federal tax standpoint, that all resides with the individual on a personal level because of the flow through nature of the S corp. But when you think about sales and use tax specifically, that liability follows wherever the sales transactions are occurring. So now you could have some reps and warrants and different portions of the transaction agreement that are either clawbacks or protections or escrows against some of those items. But the last thing you want to do is buy a business that hasn't been remitting sales tax or hasn't been charging or remitting sales tax for something that they should have. And now you have this $500,000 bogey, or in the one example that I got brought into, it was nearly $1 million liability in the city of Chicago because of their additional SaaS tax that's applied over and above their state and local sales tax rate that had been missed for 6 years ahead of the transaction. And so that liability added up to nearly $1 million over that 6 year period. You don't want to have that type of realization and discovery. Either like if you're a seller during the due diligence process, you don't want that to come up. So make sure that you are
Right.
doing everything right for your business. And then as a buyer, you don't want that coming up post transaction. Find that in due diligence. Make sure to do your tax due diligence or hire someone who understands those tax aspects and can do tax due diligence. I know we've come across like Anderson Tax has a really good tax due diligence team. We've worked with a couple others. We do a little bit of tax due diligence, not necessarily at that same level, but even just looking at some of those issues where it's like if there's a glaring issue that isn't resolved, even though most of those liabilities are covered in the agreement, you don't want to have a big issue looming as you buy the stock of that company.
It's good. Great information, Greg. Really appreciate the time. I'm going to move to the next slide. Which we talked about a little bit. If maybe today's your first time on a webinar, you don't know what we do. We are a business transformation company who does certainly evaluations because it's what's in our name. We do a couple hundred a year, mostly MSPs, systems integrators, custom app developers. We also represent, we do some buy-side work representing buyers, also represent sellers, preferably not in the same transaction. That's the fastest way to tick off two people at the same time. Try not to do that. We also do a couple mergers a year. And then Greg, the IT tax advisor piece, which is a growing piece of our business as we continue to help IT companies think through how to structure, how to think through transactions, all things related to tax. And so if you're interested in talking with us about any of those things, you can click on that QR code in the top right corner. Value Creation Academy is launching actually later this year. And so it's going to be a pretty intensive opportunity to really transform the way you think about your business. We're bringing in experts from really around the industry to help you grow your business. Our goal is to have you double the size of your business or 10x your spend with us. And we think we can help you do that. So if you're interested in getting more information about Value Creation Academy, happy to connect with you on that. Greg, a question in the Q&A. Is there a way to get around the tax liabilities, not by the company, but by customers somehow?
A way to get around the tax liabilities? Yeah, so effectively, when it comes down to your customers and whatnot, like some of that apportionment factors they vary by state. So a lot of states are a sales apportionment state. So like if you have customers somewhere, you potentially have economic nexus, you potentially have a filing requirement, you potentially have to apportion some of the gain or, the income there. Now, I will say every state is different on how they apportion income. Every state is different on how they have nexus. So what different things that you can look at doing is you can look at what are my apportionment, what are my apportionment factors in each of those states. I've seen some crazy examples where people have more than 100% apportionment when they look at their states because of how the apportionment works, because sometimes it's sales, some states are payroll, some states are a three factor, sometimes they're a double sales factor. So it's like it's really important to know what is your footprint. You do have the ability to change it. So you think about working in a remote environment versus all being located in one area. That can kind of diversify your footprint a little bit. And just by having a person in a specific state doesn't necessarily create a filing requirement in every state. Sometimes in some states it does. Like North Carolina, for example, they're pretty stingent. You have someone working here, you're doing business here, you're filing, even if it's zero. But there's other states where it's a little bit more, less than that. So if you're trying to just dilute your apportionment factors across multiple states, that's an easy way you can do it. And then by having people in other states, maybe you get customers in other states too, which also helps with the dilution of that apportionment.
Thanks, Greg. Very helpful.
Yeah.
If you're interested in getting more information about our valuations as a service, you can scan this QR code. Basically, it's a chance to really track your value in your company's specific risk factors quarter over quarter, year over year to see if you're actually meeting your objectives. And so happy to talk through those things related to VAS. I did see the correct answer to our trivia question.
Yep.
And I think it was Devin who correctly identified Cooperstown, New York as a town that I was in a year ago this week, actually. If you're a baseball fan and have not been to Cooperstown, you need to go to Cooperstown. It's probably the most magical place on earth. Not Disney, okay, Cooperstown. It's not probably my wife didn't enjoy as much as I did, but my son got to play in the Cooperstown Dreams Park experience, which is one of the coolest moments of his life for sure. Maybe dad living vicariously through his son, but a great week of baseball in Cooperstown. Unseasonably cold and rainy in Cooperstown, New York. But still a great time. So, Devin, I'll be reaching out with that gift card. But thanks for jumping on today, and also thanks to all of our guests for jumping on. You guys have made this a lot of fun over the last year. We're going to keep on doing this, trying to provide content to you that might help you as you run your businesses. Business owners to me are heroes. I don't know how you do it. You start something, you grow something. It's remarkable the courage that you all have in your day-to-day work. So we're grateful to play a small part in your success, and we're grateful for the chance to chat with you all today. Have a great week, everybody. We'll see you on Thursday for our next webinar.